You're tuned in to Agriculture Today, and we continue our show with K-State grain economist Dan O'Brien with a grain market update. Dan, thanks for joining us today.
Thank you, Shelby.
Dan, what are we seeing for futures in the grain market?
Well, of course, yesterday was the first trading day of 2025. And I'm reminded in looking back at 2024, especially in the corn market, that we had a year where literally the opening day prices for that marketing year were the highest prices that we had all year. Now, I don't know that that'll be the case here, but it's no small thing to look at what happens at the beginning of these marketing years, of these calendar years for the crops, particularly if you're looking at December 25 corn, November 25 soybeans, July 25 hard red winter wheat, and actually the December contract as well. So anyway, no small thing. And I would say, and when we look back at last year, for corn, we went from here, we went down some, came back up in the summer, but that uncertainty coming into May never reached the high of where we were at right now. Of course, that was a higher price of $6 corn. Well, we closed yesterday at 459 and a half. Pardon me, at a and a half for the March contract for corn, and harvest at 446 and a half. And generally, we with any planting uncertainty, if unless we have unforeseen problems, we'd probably be higher than that. However, that's where we stand. So anyway, when you look at the closes yesterday, as I said, March closed at 459 and a half. Dees at 446 and a half. And corn of the three main commodities has been showing some strength of late. Underlying demand concerns, underlying demand positivity, I guess, coming into play. And for soybean futures, we saw the January contract, which is now in delivery, which is a surprise. Here we turn the page and we're delivering on the January 2025 contract. So the lead, and that was 999 and a half, but the lead contract that cash prices is based off of now, the March 25 contract, $10.12. And actually, both those are up, both corn and the soybean futures are up a penny or two, a penny and a half thereabouts. And the wheat was down actually. The March contract closed 551 and three quarters. The harvest July 25 contract 569 and a half. That was down about 6 or 7 cents, depending on which contract you're looking at. And really the carrying charges, as we look at those right now, if for a lot of folks that still have old crop corn in particular, and they're looking to what signals the futures are giving them for carrying the crop. Well, we've got carries from the March to the May contract of about just under 4 cents a bushel, which is just kind of break even with on-farm storage. And if we're in commercial storage at 5-6 cents per bushel per month, it's below that. So that's not the best story for people storing, at least at this time. And the soybean contracts, you are seeing carries from the March to the May contract of about 6.25, from May to July, pardon me, from March to May, 6.5 cents, from May to July, six and about 3/8. So anyway, got a little bit of carry there, about a break-even deal as you go forward. And then carries for wheat again, all the way from March to May to July, you're looking at about 4 cents a bushel a month. And then surprisingly, when you get from July going into September, you jump up to 6 cents a bushel, 6.25 cents a bushel carry. So I think it's as you and I talked about before we came on the air, there's some more information in these markets that we can look at. At this point, with the bearishness in the market, it's sobering. I will be polite, say it's sobering to look at. But so you go back and look. When I go back and look at the December 25 corn futures and try to gauge, well, what's the market expecting? So again, yesterday, Dees corn closed at 446 and a half. When you look at a 450 put option costs about 38 cents, 38 and a half cents. So 450 minus 38 cents, you're at about uh, 410 thereabouts for the for what it would cost you to actually buy a put option and protect yourself from any downside move on D's 25 corn as it closed yesterday. And also it's worthwhile to look at, well, when people have bought put options in the past, which strike price or which price level are they buying at? Strong dominant quantity of 14,500 contracts of 5,000 bushel contracts are right on $4. So you've got, and then a fair amount at 9,000 at 440, about 6,000 at the 450 and 430 about, pardon me, 450 about 6,000 and at 430 about 6,600. So the market is sure when people are going into the corn futures contract in the options market, underlying the corn futures contract, buying their downside price insurance through put options, they're hanging around 440 or there's a bunch of them wanting to protect themselves from anything falling below $4. It just is as it is. And then for soybeans, you look at November soybeans, the same type of view. Closed yesterday at 10.28, and you look at a $10.20 per bushel strike price. And again, as a level to buy a put option at, that costs you about, well, about 61 cents a bushel. So from 10.20 minus 60 cents, you're down at 960, 950 thereabouts. And by the time you deal with brokers and such, and the most of the quantity of what's been bought in this range anyway for put options is right on $10. It's 6,172 contracts, 5,000 bushels apiece. So when these folks are going into that market, buying their downside coverage, they're buying it at $10. So and that's, gosh, and what have we seen for soybeans in the last several weeks? We've seen them hanging right around $10 or a little bit below that, come back up above it. But that seems to be the narrative mindset of people. For wheat, you look at July 25 wheat. Now take note that if you buy like a D's contract, D's option, you have to, for corn, you have to get out of that in the about half, 2/3 the way through November. By November, uh, soybean option, you have to get out of that in last part of October. If you buy a July wheat option, you have to get out of that in June. So that for us here in Kansas is a little more problematic because we may not have the crop out by then, but we'd have the price coverage at least up until that time. But so when you look at put options for July 25 wheat, and again, closed yesterday at 569 and a half, you go right to 570 for the strike price where we buy the insurance at. That downside price coverage costs just about 47 cents. So let's say it's about 70 cents. So you're looking at somewhere between 520, 525 for where the market's kind of protecting itself at. And on yesterday's market, there's not near as much volume in the hard red contract. We're talking about hundreds of contracts rather than tens of thousands in such as in corn and 6, 7, 8 in soybeans. But most of the quantity of where the market's been buying that downside price coverage at is at 550 and 560. So I don't think any farmer market watcher in Kansas on these commodities is surprised at these things. What I would add in though is that right now we have no real worries about weather risk coming in, and that's still just the very beginning of the year. And that weather risk that can express itself in in South America. Some rumblings of some issues in Argentina. Still opportunity for things to turn around, turn hot and dry in uh, Brazil, but nothing has happened yet. So we start the year in a situation where we're not really worried yet about any weather issues, and all the the trade worries that probably most concerning, probably the soybeans on the one hand and grain sorghum on the other, and possibly wheat. They're still something we'll deal with once we get past January 20th. The inauguration of the new group of the new administration coming in, and a lot of those things are positioning, framing, et cetera, until we actually get down to business and start negotiating. So anyway, I think when we're kind of looking into 2025, the markets right now are not that. It's not that they're not concerned about what will eventually happen, but for weather issues in the U.S. or what could happen, but they're not on the front burner yet. So right now we're kind of standing where we're at, and aren't that terribly concerned about anything at this moment that would drive prices higher. So we're kind of hedging our bets on these rather conservative price levels for the new crop contracts that we just talked about.
So, Dan, as we finished our first year of trading in 2025 yesterday, what are you keeping an eye on for 2025?
Yeah, for this first day, I think I'm not near as willing to discount weather uncertainty and geopolitical disruptions as the market is right now. And geopolitical issues that come in, there are winners and losers, and some of the winners and losers have to do with transshipments moving around the globe just in different directions. Or are we just shifting around the chairs on the deck? To borrow expression from the old movies. Anyway, point being that uh, I'm not near as willing to just uh, lay down my thoughts and say that, gosh, I don't think there'll be any risk and uncertainty that could drive prices higher this year. I think we're at a very docile time at this moment. Seasonally, think we get out to April, May, June in U.S. planting, and then have to deal with actual realities of what's in the field. But at this time, we're just we have the idea that, hey, we have more than adequate stocks, and we're not going to worry about anything until and these are buyers markets. Again, if you don't buy from a pile of grain today, they'll still be there next week. So with that, you take away the urgency, and you end up with prices like we have right now.
Dan, I appreciate you taking the time to join us today and give us our grain market update.
Thank you so much. Appreciate it, Shelby.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but stick around because we have more for you up ahead.